Good morning and welcome to the Flow Show. I'm not going to do a Dale and sing you a song because I was going to sing Only the Lonely this morning, as it's just me, myself and I on the show. Both Kay and Stel are off today. So might be a shorter show than usual because you don't want to be listening to me for an hour waffling on. So I hope you're all doing well. Big day today with the CPI numbers coming out, and we'll talk a bit about those shortly. We'll get over some of the headlines, see what's roiling markets or not, as the saying goes. So we will get stuck into things. On the China front, PBOC said its midpoint lower again, 7.1765, continually setting these numbers much stronger than expectations. So they're really tightening the screw, as it were, on as to giving the message on where they want the currency to go. We saw earlier this week that they've got zero inflation in China. Well, they're going to try and fix that from tomorrow because the NDRC are going to raise fuel prices from tomorrow. So if you haven't got inflation, generate it. So we'll see if that kicks into things into gear on the inflation front. Over in Japan, PM Kishida is considering a cabinet reshuffle around the middle of September. We'll keep an eye on that to see if anyone important in the finance ministry gets moved around. On the data front, and this is pretty much going against what we're seeing in the price moves. We've had, let's get on the right page. Here we go. We've had some PPI data out of Japan and much softer numbers. PPI month on month falling 0.2%, expected to rise 0.1%. The year-on-year number coming in softer than expected as well, as at 4.1 versus 4.3, and a revised higher 5.2. So also here you'll see machinery orders coming in there, core machinery orders there, which is a fairly sizable number for Japan, also coming in very negative. Month on month down 7.6%, was expected to rise 1%. Year on year, another steep loss, down 8.7%. So on the data front, and seeing as we're all data dependent, not very good news for Japan. Softening inflation, which falls into what you reader has been telling us, that expects prices to come down. But as I say, not that you'd know that in the price. Dollar yen continues to fall. One thing you need to be aware of is that a lot of this data falls right around the same time as the Tokyo fix. So there can be a lot of noise in that. A lot of Japanese data drops around this time. And that we've seen coming through in particularly the Nikkei, which I shall look on there, which is also continues to come lower, but the speed of the yen moves don't seem to be matching what's going on in stocks. So there you can see there the big data drop coming in just around that area there, and dollar yen following suit with another leg lower. Now we've seen that happening twice now. The last 2 days we've seen the bulk of the yen moves coming around that data drop time, fixed time. For the last 2 days, on Monday it was the only day where it went up alongside the Nikkei coming down. So there's a bit of an on-off relationship going on between the Nikkei and dollar yen, and as you can see, dollar yen having that leg lower at the same time as well, coming around that data period. So no let up for the selling there, and you would expect dollar yen to have risen or yen to have weakened on the back of that data, because it means the BOJ staying in easy mode. So it's going counter really to the data. Coming back to Japan, and what is, you could say, a bit hawkish is that the BOJ's quarterly survey of Japan households, 86.3% of households expect prices to rise a year from now. That's up from the prior 85.7% and at the highest level since June last year. 79% of households expect prices to rise up to 5 years from now, and that's up from 75.4%. So that survey does fall into the hawkish category for the Bank of Japan. Now, I've been looking around the wires and social medias and whatever, and we do seem to be having a growing or pick up in talk about the BOJ maybe doing something with YCC at the July meeting. It's a similar situation to what we had prior to the June meeting a couple of weeks before, and then we had plenty of BOJ members coming out, including UEDA, firmly quashing any hopes of a change in policy at that June meeting. You'll remember at least a few days before, a week or so before, he was out telling everyone, no changes, nothing should be expected, and that's what they did. He's been similar for this July meeting. So one thing that struck me is we haven't heard from a BOJ member for a few days now at all. So I'm not calling any big conspiracies here, but more so that there's a risk that we do get a Bank of Japan member popping up, maybe just to quash any rumours that they might have heard about potential action at the July meeting. So there is a risk for JPY pairs right now that we do get officials coming out and just saying no chance of changes at the next meeting, can stay unchanged. It won't be a departure from what we've heard recently, but the fact we haven't heard it for a few days may give the market a bit of a kick up the arse if they do come out. So that's a risk while we're seeing these moves south in yen pairs. Right, coming over to the RBNZ, and they left rates unchanged as largely expected. 5.5% seem to be their terminal rate for now. They say the OCR will remain restrictive for the foreseeable future. I don't think about cuts too soon. Their confident restrictive rates will return CPI to target. The level of rates at the moment is already constraining spending and inflation, i.e. doing the job it's designed to do. Inflation is expected to continue to decline, and there are signs of job market pressures dissipating and vacancies falling. Consumer spending growth has also slowed. So the conditions they're highlighting here is what you need to be looking for in every other economy. And we know it's happening in bits and pieces in different economies. Take the US, well, there's no signs of real signs of the jobs market pressures dissipating. They're seeing still strong jobs. We may be seeing a bit of that in the UK, but wages is still running hot. Consumer spending has been holding up around the other countries. We get retail sales, I think, next week from the US, so that'll give us a bit of a clue as to whether the consumer is under pressure there. We have learned this week that consumer borrowing has been, or consumer credit in the US has dropped by a big chunk. So has that had an impact on retail sales? Are US consumers finding things a little bit tighter in the pockets with now that rate hikes are really kicking in? So all these little bits of information we'll be getting answers to as the data rolls off. But in New Zealand, they're all seeing it happening now, wholesale, and that's enough to put them on pause. RBA's low was out as well, saying it remains to be determined whether monetary policy has more work to do. So not nailing down a pause from those guys. He says it's a complex picture on inflation and significant uncertainties regarding the outlook, which is posh speak for saying they haven't got a clue what's going on. The board will have updated economic forecasts and new data at the August meeting, so kicking the can and saying we'll act upon those. There has been a significant and rapid tightening of monetary policy. He's confident that higher interest rates are working and has an open mind on the need to tighten more. Now, some changes have been confirmed at the RBA. These were touted quite some time ago, but they're getting further confirmation now. The RBA will switch to 8 meetings a year from next year instead of 11, so we lose 3 meetings. But they will hold a press conference after each board meeting. So gone a bit like the Fed in terms of presses after each one and cutting the number of meetings as well. They will also release a quarterly statement on monetary policy that will happen the same time as their policy decisions every quarter. So Moving to a similar thing like the Bank of England and a lot of others giving their forecasts and statements on Mumpoll Quarterly. His Nibs, BOE's Bailey, has been out mainly talking about the UK bank stress tests in which all banks seemingly passed with flying colours, but did give a little bit of commentary on current fundamentals, saying that the current level of pay increases, talking about yesterday's jobs report, is not consistent with the inflation target, but that the latest jobs data shows some signs of labour market cooling. He did also say that he believes it looks like wages have peaked. In my opinion, he's set himself up to get another kick up the arse, because if we see wages going up next month and the jobs market reversing the dip in unemployment that we saw this month, he's going to end up with egg on his face yet again. And I wouldn't rule out that happening. Now, in other news, the UK is planning to overturn a ban on naked short selling in the gilt market. The Treasury says the EU ban that was put in place, that we are under that rule, has hurt liquidity, and they want to reverse that rule to provide liquidity back into the market. They also want to overturn a ban on naked purchases of credit default swaps. Again, another liquidity measure there. Now, for those who may not know what a ban on naked short selling is, if you want to short gilts in the UK or in Europe, indeed, you need to be holding or have borrowed the underlying gilts in the first place. So effectively, you're lending out what you've already got, or by selling it. So it means you can cover the position because what you've sold, you've got in your pocket. Doing it naked means that you don't have to hold the underlying asset. You can just short sell to your heart's content. Now, whether that means that they are seeing some stresses in gilt markets, we know there was such last year when the trust stuff, or what was pointed to the trust stuff as a reason for pension companies having a few issues. That's one of the reasons why they're looking at this. It potentially gives the market the ability to sell gilts into the market, even if they don't own them, and provide liquidity. So that's what's hopefully coming from, as far as the UK Treasury is concerned. That will need to go through Parliament and whatnot. So it's going to be some time before all that happens. Deutsche Bank is another one jumping on the 50 pip rate hike in August for the BOE, though they're keeping their terminal rate at 5.75%. So make of that what you will. This is more banks changing their forecasts and aren't worth the paper they're written on. Over to the Eurozone, and Lagarde will be happy with this because Eurozone finance ministers have finally agreed to wind down energy support measures. They will also apparently use savings to cut budget deficits. That's according to a draft Eurogroup statement. You all know from following ECB press conferences, this is a big line that's in Lagarde's statement and the ECB statement regarding fiscal measures, and that they've been calling for an end to energy support measures for quite some time. Well, there's a draft statement saying that they may do such. How long that takes is anyone's guess. We'll probably still be arguing about it in 2028. Over in the US, just a small bit of data out yesterday from the NFIB. If I can find it. Where is it? There we go. Coming in, this is a small business optimism index, only a small number, but it does tend to give a good insight into what's going on at smaller firms. And it showed a nice rise to 91, beating expectations and up from the prior. So more soft landing looking numbers coming from the US there. On the geopolitical front, you need to be aware the NATO meeting kicks off in earnest. Today, all the bigwigs are there. Russia is obviously keeping a close eye on it. We have this talk about Sweden potentially now getting the green light to join NATO after doing whatever deals they've done with Turkey for them to give it the green light. Russia's Medvedev says NATO's military aid to Ukraine brings World War III closer. So expect a lot of this geopolitical back and forth. We're likely to get a lot of headlines out this NATO meeting. We will likely get a statement or a draft statement dropped at some point in terms of what NATO has decided to do for the foreseeable future. Expect a Russian reply to that as and when it comes. But for lack of anything else today, until we get the CPI data, it's going to be geopolitical headlines probably that rule the roost. So let's take a look at what's coming up from the data today. CPI is obviously the big number. That's what everyone's looking at today, as well as the BOC after that. So plenty for loony traders to trade today. Expected numbers, CPI expected to drop quite significantly to 3.1% from 4%. So that's quite a big margin that we're expecting now. Give or take 2 pips either side, the market will accept that. The only thing it may not do is if we get something that's higher. If we sort of maybe coming in between, maybe 3.5, 3.6, 3.7, that's not going to be healthy for the Fed. They will keep rate expectations buoyant. Anything below that number, and I think if, as Stelzy mentioned, get into a 2% figure, it may change July rate expectations somewhat. It's certainly going to then put pressure on a second hike thereafter if that number has a 2 print on it or 2 handle on it. But outside of the headline number, we've got to keep an eye on this core number, expected to drop 3 pips to 5%. Now recently it's pretty much gone against the consensus. It hasn't dropped as far as the market's expected. So this is going to be a big number. This is where probably most of the price volatility is going to be. Anything above 5%, close to 5.3%, again, is going to look or keep the Fed talking hawkish. I think if we get a 4.9, that's going to be there or thereabouts. Anything, let's say 4.8 and lower, that again is going to raise pause expectations, at least for a secondary rate hike after the expected July hike. Also keep an eye on the real earnings numbers here, because they are obviously taking into account some inflation, and we get some report the year-on-year numbers, some report the month-on-month numbers. Just keep a secondary on that as a bit of a backstory there. So CPI is going to be the big data mover. What's going to happen with the dollar? Well, we've seen after pretty much every piece of data, the dollar's moved. Now, the recent data has been pretty solid. The ISM was good, not the NFP was good, but the data, the dollar had dropped after each of those. So is it going to be a case, particularly for a pair like dollar yen, that if we get hot inflation numbers, i.e. higher numbers or not as low as expected, and we get a rally, is that going to undo a lot of this, or are we just going to be seeing the rally sellers jumping in at a good opportunity and smacking it down again? For me, there's no need to change what's going on now. It's going to take something big, I think, to change this right around. So I would potentially be in rally sell mode on hot CPI numbers. Now, conversely, the market is expecting a pullback in inflation. So if that gets confirmed, are we going to see a bigger shove lower? That's going to be on the size of any variation. Close to the number, I don't think we're going to trouble the downside too much. But if it is a big lower miss, then I expect this to continue on our way. And we're probably going to be driven by what happens in yields. Yields now looking at 10s, well back below 4%. And as you can see there, already resisting at 4%. So this looks like a bit of a fake out right now. It broke, it did hold, but then we couldn't get up past the next big level at around 4.9, and now we're back below. So I think yields are going to be the big story in terms of what the dollar does today. So keep an eye on those. If you're going to have some charts open, maybe do a side by side, have your yields open alongside any dollar pairs you're looking at, because what happens here is going to be important. If we get back below 3.9%, we're going back into the box, and then we're looking at 3.9 back down to 3.7s, 3.6s, and we're trading that again. So all to play for as far as the dollar concerned. And we've also got the Bank of Canada. The market is expecting a 25 pip hike generally. Expectations are leaning that way. I think it's a bit closer decision, purely based on that last CPI report where CPI dropped to 3.4 from 4.4%. One of the reasons they came off the pause was a rise in inflation, and it didn't rise as much as it fell in the last report. So if they're going to hike on a smaller increase, they should definitely go on a pause on a bigger decrease. But that's just my thinking anyway. So I think a pause is a bigger risk today than a hike. That'll certainly be a bigger price risk. So again, if you're trading the loonie, you need to know where the bigger price risk is. If they go 5%, if they go a 25 pip hike, that's what was expected. We'd probably see pretty limited reaction. Obviously, we need to read the statement in case they indicate there that they're going back on pause, or whether they're going to continue hiking. So for the loonie, and we'll take a look at a few CAD pairs, or a couple of CAD pairs. Loonie, it is, it isn't. It's another one that's got an on-off correlation with oil at the moment. Sometimes it is, sometimes it isn't. You know, we saw oil rising the other day, and dollar CAD was rising as well, which you'd expect the CAD to gain, not weaken. Now it's got a bit of a double wind in terms of seeing general dollar weakness and with oil going higher as well. So what levels are we dealing with here? So I'm still been looking at the 130.80. We didn't quite get down there, but this is the area I'm looking at. 130.80 is still one of my main support points down there. This move to close to 131 may have been a bit of protection off that 130.80, but I think we're in range potentially if we get some big news from the Bank of Canada. If they hike and say they're still looking to hike, and we've still got strong oil, then I think we're in danger of having a move down to there. And what happens there will be important. If we can't get through, that could provide a decent support point for a bit of a range to develop. Conversely, if they hike as expected and then go on pause again, that might be seen as a bit dovish. I'd expect us to be up troubling 133 again, and maybe even going up to have another look at 134. Now you've got to be careful with the Bank of Canada, because we've got a press conference this one. You can get an initial move on the announcement, market chews it over, it makes a move, then it can sit and do nothing through the press conference, and that can suck a few people in to think that any move you've seen over the announcement is going to hold. So if it's made a high and it doesn't trouble that high again, then you think maybe a top is in, and then people come in and short against that level. What I've learned over the years with the Bank of Canada is that it suffers from second wind effect. So once everything's passed with the presser, if there's no more headlines or anything notable coming out of that, the market will carry on that move in the direction it first went in. So be very careful if you're trading loonie. Don't think that a move on the announcement is the end of the story. You might need to wait until the end of the press conference, give it 5-10 minutes after, just to get maybe a confirmation. If it's made something like a high over the announcement, if we get up there after the announcement, that's your level to watch. You break it, we're off and running. If it holds, then that gives you conviction to maybe try a fade play, if that's what you're looking at. EURGBP is one I'm probably going to keep closer attention to over the announcement. We're probably a bit too close, but I've got my big old level up here, the 146, call it 146 and a half, a real monster level that we've traded previously, goes back years. And as you can see, particularly from 2021 through 2022, 2023, a huge level. These are the big levels I like, because you know you're likely, there's a very good chance you get a lot of action happening there. We're only 80 odd pips away from it, so it might be a bit close if there's any big news coming out, particularly bearish news or dovish news from the Bank of Canada. But if everything's all in line, they hike the 25, they say they may pause, they may not pause, it's all a bit neutral. This might be an area, if we get up there, that might be worth tapping on the head. But I will see what happens. It also a good level to look at least on a closing basis. We may get a big shove up through, you know, a bit of a knee-jerk reaction. Where it closes after will be important. If we come down later on tonight by the close today, we're back below it, I'll tend to think that the level is going to hold again, and maybe I'll try a few shorts into that level. On the downside, it's pretty much big figure tennis into 145, probably 145.10 down to the big figure, then maybe down into 144s, down into 143s. We're probably way too far away to trouble the fib down here, which has been a level down around these this double bottom here and this fib. Way too far away, I think, unless there's some really hawkish news like they go a 50 and indicate more. So I think that's out the woods as far as picking up longs down there. But as I say, keep an eye on the big figures on the way down if you want to trade that one. Right, looking around some of the other pairs going on, and back to dollar yen. Now we have got down to one of my, or close to one of my areas that was eyeing for support, which is down in the low 139s. This is the 38.2 fib of the whole of the big leg up. Well, I say big leg up. Some people are, let me get it up. Dearie me, come on. There we go. Some people have been drawing fibs from this low, whereas I've drawn this from this low. The reason being, in my opinion, fibs are drawn on clear swings. So this was a clear swing, but then it ran out here. So you could have fibbed this one on its own. So to mark from here all the way up here, I think doesn't really work, because you got a big 800-900 pip swing down in the middle of this move. This is a proper swing because it's more one-way traffic all the way up. That's why I've drawn my fib from that point rather than this point here, because this is a huge move in between, and it really takes some away from what fibs are supposed to do. That's in my opinion. Everyone trades things differently. Everyone can tech things differently. That's just the way I do it. So that was my area, first watch area. As mentioned, we do have a bit of a short-term trend line coming in here as well, which might be notable. It's a prior support and resistance area anyway. So there's a bit of confluence in this area at the moment. I don't think it's as big as the 138. It might prove to be, who knows? We're finding a bit of support, not quite into it yet, coming in around you know, the lows 139.30s, which again, depending on where you draw your pencils, this low in here is probably got a bit to do with it. So it's a bit of an area, because you can see it's a bit messy around here into 140. 140's been a bit of a pivot. We've been above, below when we were looking to make the break higher. So it's a bit of noise down here, and even the 139 level, you know, has had a bit of noise below. We've had previous breaks below, but you know, this is over the course of a month or so where we had holds, we had breaks, we had holds, we had breaks, we had holds. At the last lot, it had a hold, so that's why it's on my chart. And as you can see down here, we had it was a form of resistance point when you got up to 138.90s. So anyway, a bit of traffic in here. Will this mark a bottom? Who knows? The CPI data could be a bit sink or swim for it. If the data means that the dollar's going lower, it needs to get through this level. Again, I'm going to be looking at this for potentially how it closes. If we get a little, you know, blow through on the data, but it quickly comes back above and starts showing as support again, that would give me a bit of a signal that maybe we've halted this move, at least temporarily, for a bit anyway. It won't potentially mark the end of it, but all you lot who like to catch knives, you need to look at the price action. What you want to see is an extended period of a particular level becoming support. A session, 2 sessions, 3 sessions. Once you see that price action where we're not breaking any further lower, because that hasn't happened all the way in this move here. There's been no real times when we've held a low for longer than a proverbial 5 minutes. So if you do see lows developing, that gives you a bit of confidence to say, right, well, something's happening here. I'm going to try it along here. I wouldn't have been happy trying longs any of these levels here, considering how we carve through them. And what has been significant, as I've highlighted, is that pretty much at every break point, we've then found it resistance. We've broken it, can't get back above. Broken it, can't get back above. Some points, resistance, resistance. You know, when you see price action like that, you know it's not a train you want to step in front of just yet. What you want to see is a new low made, a bounce, come back to that low, maybe not get as low as the prior low, hold. Even if it doesn't bounce strongly, if you just get a little bit of zigzag action that shows a period of time where we're not going lower, that then raises the expectations that you might get a bit of a bottom and a bounce. That's the price action that I would look to trade. And still, it wouldn't be a big trade. If I was buying down here into this area, I'd have a stop below 138.90. So maybe 20, 25 pips risk at maximum in case that isn't the bottom. And that's a similar case for, well, just before I go on to the other ones. So in regards to what this needs to do to get back up again, you can see where the clear points are. 141, we'll call it 140.90, 141. That's where we need to go. You know, that's 125 odd pips away. So quite significant, but look how fast we've come down in all this. So it's not out of the realms to see a push up to here. If you start getting resistance coming in 140.60s, meaning we can't even get up to that 90s, that will tell you that we're not finished potentially with this trend. Then maybe we set up a bit of up and down range between these lows and that area. And then we have to wait and see which way it breaks. So just to go on to another pair, dollar mex. This is the sort of price action I'm talking about you want to see. So, you know, we know we've had a period of heavy downside. There's no denying what the trend is like, but here we have a period where it's not breaking lower, and that's lasting for quite a while, pretty much a month. We're not managing to break lower. That's the price action you want to look at. I'm long into here. I know Blake's long into here as well, and I'm purely long pretty much on a scalp because we've stopped going down. And if we stop going down, there's a high chance that we go up. Now, what I am concerned about, particularly for this pair, is that we may not be going down anymore, but we're not looking like we're bouncing very well either. We had that move to 1740s, and look at the bounces since there, 17s, 11s, and now we can't even get above 6, 10s, anywhere like that. So price action wise, as I sit here right now, I suspect we're more likely to break lower than break higher. Hence why I've got stops just below this low here, and I'm reversing to a short. And in fact, today I've actually increased the size of the reverse. So it's now going to be bigger than the long position I'm currently in, because if we aren't bouncing and we're going to break down, it's likely to be quite volatile. So I want to try and capture that move initially on the breakdown. But in terms of catching knives, this is what the type of price action you want to see. A more solid bottom being formed. That gives you conviction to try long. So that's what I would apply to something like dollar yen when you want to try and catch your knives. Let the price action develop for you. Looking at, someone's asking about euro dollar. I think this, while, and pretty much the same thoughts with cable, it's rallying, but it doesn't look convincing. I don't know if that, if you understand my meaning from that. There's times when something rallies and you think, yeah, I get everything behind why it's rallying. And then there's times when you get something like this, a rally, and you think, well, it's not really anything to do with what's going on in Europe. It's merely the effect of what's going on in the dollar. You know, if Eurozone CPI was still really running hot, if the data was really strong, you know, you think, fine, I can get behind a euro rally. At the moment, I'm not convinced. We are edging up. 111 has been obviously a big level. That's the one I've had on my radar for a potential short, trying that 111 level. Over the data last week, I was thinking perhaps about 110, but given the price action that we've seen, not really interested. So I'm going to sit on my hands, keep my powder dry, maybe have a crack at 111 on a first test, but I won't. It won't be a huge trade, and I'll keep it tight, maybe just above this trend line here. See if that holds. Again, we're well in the realm for the data to get up to there. So see what happens with that. On that side, for the downside, I think this has the potential that if it is going to move back lower, it could move back down with some speed. And I wouldn't be surprised maybe if, you know, the dollar weakens, if the dollar strengthens on this, we get a move back to 109. But I'm not expecting any big breakouts here. We couldn't get down to 108. So I think potentially, outside of big news, we're probably going to be looking at something like a 108, 108.30, 111 range on the wide, and then we might develop something in between, maybe sort of 110, 109, something like that, as we head into the summer months. I think this pair will really quieten down once we've got all the summer central banks out the way, and then everyone packs up and goes on holiday. So until then, I'm looking at merely range playing for this one. Over on good old cable, and didn't quite get up to the 130 just yet, but we're edging up near 129.70. Again, I'm looking at 130 potentially for a big figure scalp. Haven't had confirmation of whether there's any barrier activity going up there, but I suspect there will be. So I'm happy to give it a little tap if we get a move up there. However, I'll be very careful if we're close to that on the data, because if it's a big data number, big variation, then that 130 could blow pretty easily. And again, this will be a level to watch on a closing basis. If you blow on the data but quickly come back through it, then I suspect it's then going to firm up as resistance again. Everyone's done their data trading, and we get back to what's going on normally. So you don't need to get a reaction straight on the data. You can give yourself some time, see what happens, let the price action do its thing. If it blows it and starts building support there, fine. If you want to be long, that gives you your clues to say, right, get in at 130, tight stop. If the 130 is holding, fine, then we're going to carry on higher. If it blows above, comes back below, then holds as resistance again, that tells you, right, we've had our data messing around, the 130 is a solid level, then perhaps I'm going to try shorts. What I won't do, as a lot of you know, is guess into a number. I won't buy it and go, oh, I think CPI is going to do this, so I'm going to buy this or sell that. That's just gambling. It's a coin toss. I'd rather react to the price action after, let it tell me what it wants to do, and then hopefully try and react to it. Right, you're going to have to excuse me 1 second, because euro sterling is getting up to the 30s, and I need to take some off. I've been buying some into the big figure, so I want to close off some of that in the 30s, and I'm just going to do that. There we go. Thank you very much. So we have pretty much held a first test at least anyway down here into the 85. That's why I've been taking pretty much a scalp long into there. If you've been watching the show long enough, you know I've been banging on about this level. Well, we've had a test. We've got a little bit of bounce. So I'm going to take some money off the table, as just mentioned. I still feel like this could crack, though. And while today's CPI numbers won't directly impact it, I wouldn't trade euro sterling on the back of the CPI. What may happen is that we've got the usual volatility difference between the euro, dollar, and cable. So if the dollar's moving, cable often moves more pips than euro dollar. So if we get more weak data or very soft CPI numbers and the dollar weakens further, cable's likely to move more than euro dollar. If that's the case, that's going to move euro sterling. So that's going to be the reason why euro sterling might break through here. Now, if the data suggests that the Fed's going on pause, that leaves the Bank of England hiking and increasing the rate divergence over the US, which will add a bit of fuel to the fire for cable, meaning that's going to shoot higher. That will mean that euro dollar likely will lag behind. So that will be the reason why this will break. Not because there's any real major change between what's going on between Europe, the ECB and the BOE. Both of them are hiking, but it's purely the volatility in pound versus the dollar that could cause this to go through. Now, if we do go through on that front, that'll be fine with me. I may give some money back on the trade, but I want to see that bigger move because I'm still looking to counter these rising Bank of England expectations. And I'm going to be looking at starting to build a significant long for the longer term if we start getting down towards these big range lows down here. So I'll be happy to see a break in one sense, not for me scalp probably, but for starting to put on a longer term trade. As I mentioned, I've got a big itch to short the quid. I think we're getting close. So if we do get a breakdown there, I may start adding that on. And we'll see what happens with that one. Right, excuse me. Right, guys and girls, if you've got anything else you want to speak about, chuck it up. Just want to grab a quick glass of water. See, that's why I have the other two guys on the show, because I can pass it over to them while I go and have a drink and read the paper. But as I'm on my own, no, it's just me. So I'm going to have to take a break now and again. World peace, yeah, we'll all vote for that, Bran. Not sure we're getting it today though. Maybe tomorrow. Who knows? We can but hope. Right. So if no one else has got anything, I'll have a quick look around. Aussie dollar. We did get a break of the 67 yesterday, and look where it ran into trouble. Ran into trouble at 67.40, which is another old support and resistance line in there. So this one's really playing nicely with the techs at the moment. It's not doing an awful lot. If you think how far cables come, how far dollar yen's come, a lot of other pairs, but this one's really staying quite tight. So it's not really following any real fundamental reasons. It's not jumping on any bandwagons. You know, the dollar's weakened, but it's not really weakening. It's coming back off bounces, which I think is pretty significant. So again, this is the sort of thing you want to look for if you're trading 130 in cable. If you're trading the big level in EuroCAD, 146.5. When you get these big levels, if you get something like this, is a top price action I'm talking about. You get a big move through or a decent spike through. What happens after? Quickly after, it doesn't hold, runs into trouble. It comes back under the level again. So that's the sort of price action I've been trying to explain about cable and trading over the data. You know, that doesn't tell me we've broken here. That says to me we've had a quick move out, but it's come back pretty well. So the rally sellers have gone, no, thank you very much. That's a gift for us, and we're going to jump all over that. But for me, Aussie dollar, it's not really going anywhere. So if you want to trade it, trade the ranges. You know, your 67 level here is your pivot. You've got some minor zones underneath levels down here, obviously down into bigger levels down in the 60s, 65.90s, that sort of area. Again, this might be setting up for a possible decent summer range to trade. So pick your sides, pick your levels either side of the range. You don't have to mess around in here. Sit back, put your feet up, wait for your levels to come to you. And if you get them, that gives you some good conviction to get in a trade, because you know they are tried and tested levels. Brian, you're sick, go and get a kit, mate, if you're not feeling too well. RA says the USD JPY price action is US interest rates going down and speculation and possible hardening stance of the BOJ. I don't think anyone's expecting US rates to go down. I think we're still trading two hikes, and then we'll be trading a pause. So The market has tried, the old pivoters have tried to predict rate cuts. They did that beginning of this year, and they got taken to the cleaners on that one. I'm not seeing a lot of people, I'm not seeing a lot of commentary on when US rates are going to go down. As I say, that was more prevalent at the turn of the year. But you're right, on the BOJ, there are some increased chatter, shall we call it that, about potential action at July meeting. I'm a bit cautious about that. I think there, as I said earlier in the show, there is a risk that we get BOJ officials coming out and putting to bed any expectations like that. There is no reason why they would change policy now over why they didn't in June. The picture isn't largely changed. If anything, it's a touch worse on the inflation front. Yes, there's been a lot of talk about this wages stuff. Yes, there's been talk about the consumer potentially weathering through the inflation rise and prices going up, and Gavin put a good story up in our newsroom to do with that, about how consumers have been happy to pay higher hotel prices, restaurant prices, so on and so forth, which is what the Bank of Japan wants to see. But then on the flip side, we're seeing prices just easing off a touch, inflation just easing off a touch, and that falls into what the Bank of Japan have been saying, that they're expecting prices to come down, maybe even below target in the second half of the year, second half of the fiscal year. So we're not out the woods yet. Until we get a sustained period of inflation well above target, it doesn't matter if the consumer, if wages keep rising, if the consumer is happy to pay more and their sentiment is changing. Until inflation holds up, stays above 2%, probably stays above 3%, and keeps going up or keeps staying solid well throughout the next 6-9 months, that I think is the only time we see the Bank of Japan really looking to change policy. Yeah, we might get the odd YCC change, particularly if there's any issues going on in the bond market. But YCC isn't rate hikes. YCC is just allowing them to widen what they control and give the market a little bit more freedom. But yeah, I mean, you probably know our thoughts here in the Flow Show. The Bank of Japan has never had a greater opportunity to come out of their easing cycle. It's just a question of if they want to take that opportunity or if they don't. Hence why I'm not too keen on the move lower in dollar yen. Again, it's another move I don't trust because it's going against the fundamentals. The US is coming up strong. Japan is still easing. There's no reason why that should change. But that's markets for you. They don't go one way forever. And the harder they go, the harder they fall. You know, it's been a big old move up since May. No surprise to see at last a decent pullback. And the fact we still haven't got to that 38.2 fib tells me that we're nowhere close yet to this trend breaking, no matter how many pips are involved in that. But yeah, you got some thoughts there, RA. Anyway, oh, you meant the US market overnight, interest rates overnight. Well, yeah, you're going to get these changes in obviously overnight rates and things like that. You just need to look at look at what's happening in the bond market to see that. As for the Swissy, I've got two real hopes of trading that one. What we were looking at yesterday, we were looking at whether it was going to move and hold below this 88 level. It's done that, as mentioned. I had this level down here, 85.75. Let's just stick that on, which I think was the Feb last year. Can't remember. Where was that low coming in? Yeah. Down here, the 2021 or the 2020 low, deck 2020 low. So that's your marker there. We did get the break under. So was it you who was short, RA? I know someone was short on this one. So you got the break. I said this is the level you want to be looking at in case it taps it and holds it. That's the one you want to get through. We got close enough to it by, what's that, 6 pips. And it's bounced from there. So hopefully you took some money off the table there and you can manage the rest with stops. And if you get a bounce to here, and it holds, then further downside is going to come back above. The picture might be changing. So if you're short up above, bring your stops down. Nothing wrong with that. Lock it in, you know, somewhere just above that high maybe. Give yourself a bit of room. If you get a break of this level, you can then bring your stops down and manage a trade, and really try and run the trade as far as you can. If you want to take it all off, fine, take it all off. There's nothing wrong with that, but I do like to run a trade as far as it will go. Right, if no one's got anything else, I'm going to call it a day in case my voice runs out. I think still, at least we'll be back tomorrow. I think Kay's going to be off for the rest of the week. Be safe over the CPI numbers, please, folks. Don't guess. Trade what you see, not what you think. And we'll find out tomorrow what happened. And hopefully we've made many pips. Have a great day, everyone. Thanks for coming to the show. See you all tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.